but it's really comes down to that financial freedom that really is just a tool to be able to not only spend the time as most syndicators talk about, freeing up your time through passive income, which is a big one. But in my eyes, it's a good day job while also creating some of that freedom through the passive income.
Welcome to the Threefold Real Estate Investing Podcast. This is the podcast where you'll not only learn how you can achieve massive success in multifamily real estate investing, but also how you can simultaneously pursue great relationships with your family and a better walk with God. You can achieve financial freedom through real estate investing without sacrificing the relationships that mean the most to you. Now, here's your host, Lee Yoder.
Welcome back, Threefold listeners. I hope you're having a great week. We've got another great guest today. Evan Polaski is joining us right here in Cincinnati. I've known Evan for a while, but this is the first time I've gotten to have him on the podcast, so really excited to bring him on. First, a little bit about Evan, and then we'll bring him in. Evan is the Managing Director of Investor Relations at Ashcroft Capital. Throughout his career, he's spoken with thousands of investors looking to gain exposure to real estate. These investors range from individuals looking to make their first real estate investment to seasoned investors with decades of experience. Personally, Evan has invested in real estate since 2007 through public and private REITs, direct single family and small multifamily, and to passive investments and larger deals as a limited partner. Evan has focused the majority of his career in real estate. But Evan, thanks for joining us today. Really excited to talk to you.
Yeah, my pleasure, and definitely thank you for having me.
Yeah, absolutely. So Evan, if you don't mind, real quick, just take us back, short version, but how did you get into real estate? When did you start? I mean, your bio said you've been investing since 2007. Was it then? What happened? What got you interested? And then a little bit how you got started.
Yeah. So as I told Joe Fairless in my interview, when I was interviewing for the job at Ashcroft, I remember being really small. Like I was 7 years old living in suburban Atlanta, and they were building a new Publix anchored shopping center around the corner from me. And just being fascinated by the construction, by like just the fact that this is a thing that there's tenants in, and obviously at that age not really understanding the financial side of it, but just having a natural draw to it. And whether it be single family homes and stuff there, or shopping centers, apartment complexes, etc. I always remember having this like draw to real estate. I went to University of Cincinnati in the engineering program and realized this isn't really the right path for me.
Okay, sure.
And moved over to the business side, and was actually working with somebody as part-time college shop who was in the real estate program at University of Cincinnati. So transferred into the business program, went through UC's real estate program, and then thankfully one of the few people it seems that got a job in my chosen field. So my first job was in real estate, in investor relations, and ultimately it was coworkers at that first job that started buying single family rentals. And I was starting to make some money and said, I'm going to buy a house down by University of Cincinnati. College kids, built-in tenant base. And they all talked me out of that. They said, no, don't do that. Go into these single families in the suburbs, actually Section 8 properties at the time, because this was in the financial crisis. That was really like the Kickstarter of buying my first rental property.
Nice.
And from there, had the big dreams, as I think many people do, of I'm going to have 50, 100 of these, and I'm going to make so much money and all that stuff. And then you start to realize, like, this is a lot of work.
Sure. Yeah.
Find myself a job. Like I can't do this part-time. So again, grew that portfolio, but ultimately realized that there's only so far as wanting to take that. And like the investors I talked to today, have, knock on wood, ultimately found a career in my day job now that I love, and has really pushed me more into that limited partner side.
Yeah, absolutely. Yeah, I think your story is common among a lot of people that get into real estate. And so you see it, and the numbers make sense. And then, you can read up on the history of it, see other people that have done it. It's a tried and true, great way to create cash flow, for the real estate, because, typically your rental income should be higher than all your expenses, and then create tremendous wealth as you pay off debt, create equity. Inflation happens, you have appreciation, goes up over time, and you can create incredible wealth. And so people see that, they want to jump in. Most of the time, people, especially if you're a go-getter, like you are, Evan, it's like, okay, I'll go do this. I mean, I can do this. And really anybody can, especially if you start small, you do, single families or even small multis. you can really jump in. It's just like getting a second mortgage, buying a second house, but you just let somebody else live in it. Right. And you can go do that. But yeah, even, sometimes people experience it with one, but certainly as you start to get a few and you get a little portfolio, you realize even if you have them professionally managed, which did you, Evan, or did you manage them yourself?
So for the most part, over the last 11 years, I've self-managed.
So definitely, if you're managing them yourself, I mean, you should know that it's going to be active. And even if you find good residents, there's just always stuff going on. Again, especially the more units you get. And then, even if you have them managed by somebody else, I mean, the buck stops with you. They're coming to you with questions. You got to get involved sometimes. I mean, you're making a lot of decisions. So, I've interviewed plenty of people that went that route and it still ended up, feeling somewhat active. So unless you are a passive investor, which Evan and I will get into, and we'll explain more of what that is if you don't understand that. But as long as you are the one signing on the loan and purchasing the property and the buck stops with you, it's your property and you're the asset manager, even if you aren't the property manager, you are going to be active. But for a lot of people, Evan, they really enjoy their job. They like what they do. They want to keep doing that. They make good money at it. And they're just saying, well, wait a second. I just want to invest in real estate. I don't want to be a property manager. I don't want to be an asset manager. I want to do my job and I want to make some extra money. I have some extra money to invest. I don't want to put it all in the stock market. I think more and more people today are maybe thinking that, hey, I really want to diversify. I want to get into real estate, but I don't want to be active. Maybe I tried it and I had the same experience as Evan, or maybe I'm just going to go ahead and learn from Evan's experience. I want to do it passive. So Evan, you got to that point. Now, as I set up, like your job is to talk to people that are maybe at this point. And then when you do it passively, tell us a little bit more about that. What helped you make the transition and what has been the difference now that you invest passively instead of actively?
It was really a numbers game. I mean, it was a numbers game. It was also a lifestyle game, decision.
Sure.
But
tell us about both of those.
Yeah. So, a lot of the properties that I bought, I was buying in 2011 and 2012, especially my long-term holds. My wife and I have done some flips since 2014. She does a lot of them, but I've always helped.
Oh, cool.
Her. So that's been happening. We've been buying since then, but on the long-term holds, the actual rentals, it was starting to look at the numbers and saying, all right, I bought this house for $35,000. I'm making, $1,000 a month in rent. And I refied it. Most of my houses, the first three, I bird before it was officially known as bird. So I have to age myself a bit and say I'm an OG in that front. But but I bought them, I renovated them, I rented them. I had to hold them for 12 months, or the first few I had to hold a 12 month before I established a relationship with lenders. And I was able to refi all of my money out and then some. Awesome. So I was into the infinite return that everybody sees with those. But then I started looking at, all right, I've got this house that's now worth $150,000. I've got a $35,000 mortgage on it. So like my leverage is next to nothing. But when I really conservatively underwrite, particularly like my repair budgets, you and I have probably seen this on Bigger Pockets a lot. People are like, yeah, I'm going to withhold 5% for repairs or 10% for repairs. And I'm like, no, to me, that's just not realistic on a true long-term hold. Yeah. And I'm not talking 5 years. I'm talking, I'm at 12 years on the two houses that I currently have. 15, 20 years. If you're going to make a lifetime of investment out of this and make it just that mailbox money, you're holding a long time. But that means a roof. That means new kitchens, new bathrooms, updated plumbing, hopefully hopefully no more than once in your ownership. I had to do that at a few of my houses. Furnaces, water heaters, etc. And at one point I ran a spreadsheet and I just kind of went through everything. I said, all right, a roof costs $6,000 on average in today's money. They last for 25 years. I forget my math exactly, but that's going to cost me $20 a month every single month in repair reserves.
Nice.
To replace that roof in 25 years. And that's with a brand new roof. If I have a shorter period, I need to reserve more than that, obviously. All right. The kitchen needs to be remodeled. The typical value add play. You get top dollar rents when you have new cabinets, new counters, new appliances. Appliances are going to wear out anyways. There's a certain balance of CapEx and repair into this number. But I'm like, that's going to be $15,000 every 10 to 15 years.
Sure.
Okay. Well, that's another, call it $10 a month. HVAC. And you just start adding all exterior paint, decks, fences, all this stuff that comes up. And all of a sudden I'm looking, I'm like, I've got to reserve $450. I think it was $440 a month to fully fund all the repairs and the upgrades and everything else over their useful life.
Yeah.
And that's if everything's new.
Yep.
Now, again, this assumes that you're going to be a true long-term hold. You're not going to, not going to hold it 5 years and sell before all that CapEx starts hitting, which is totally fine. So $1,000 a month minus my mortgage, minus $440 a month, interest and taxes and all the stuff. And I'm like, I've got $150,000 or what, $110,000 of equity in this deal, and I'm only making like 4% return on equity. Now I could refi and increase my debt load, but then I'm start cutting it close. Like I'm not really cash flowing anymore because I'm truly reserving $440 a month
Right.
for everything.
Yep.
Now I never had a huge portfolio, so I didn't have like full-time maintenance people that can, that's just a salary,
Sure.
$22 an hour times 40 hours a week, kind of just send them where they need to go, which can certainly help cut that down if you have a bigger portfolio. As you well know, I also live in Hamilton County, which tends to be a high, and that's where my rentals are, tend to be a higher real estate tax area. So that kind of kept biting in, and they would push for years. And so really, as I said, it came down to the numbers. I'm like, I can invest passively and make, 5% year one and let somebody else grow that year over year. Granted, those are just projections, and get that upside. Or I can keep making 4%. And yeah, I'll keep getting appreciation as well. But I've done a lot of the major renovations, so I'm not able to like push that value dramatically with like a true full rehab. So that's what came down to. I'm like, I've got two small kids. I don't really want to be called to roof leaks and everything else anymore.
Right.
And as I've talked to investors from time to time, it's as the portfolio grows, it's not even the work necessarily, because it still is a fairly high paying job relative to the time that you're having to put into it.
Yeah, sure.
If you're cash flowing $100 a year or $100 a month, but you're putting less than an hour a month into it, like that's a good income.
Sure. Yeah.
But to me, it started also to get to the mental fatigue.
Yeah, your overall point's so good, Evan, in that with a small portfolio, even with a small portfolio, there's some work that goes in, there's some stress, there's because it's yours, you're responsible. My wife and I ran into that. We just had one duplex and we had great residents, and it just felt like a weight though, and neither of us really liked it, especially since we were managing it ourselves. Now we still own actively, but we have a property management, and even just that knowing that if something leaks, if they're going to call somebody else and they're going to take care of that because that's what they do professionally. So even that just felt like taking so much weight off of us. But I love that you really highlight, you kind of went in there, the CapEx expense that, over time, because it is kind of easy to forget about that and go to just some rule of thumb that let's just hold back 5% for reserves, because that sounds like a good amount, and you can, build up. I mean, the numbers are different on a single family compared to multifamily, but on a single family, hey, I'm putting back $5,000 a year or whatever it is.
Yeah.
But I mean, you do a water heater and it's gone, or you do a big furnace repair to replace some plumbing and it's gone. If the CapEx stuff can really sneak up on you, and all of a sudden you realize it's not as good as you thought. And then you make a really good point, Evan. I think this kind of transitions us into multifamily, and then maybe even talking about doing big multifamily and doing it passively. And then you said, a lot of these expenses, you're not going to go out and do it yourself. And you don't have a team because you don't have enough work for a team, or even, you don't have a full-time maintenance guy because you don't have enough work for a full-time maintenance guy. So when you go, it's to the professionals that go, oh yeah, Evan, I'll come out for this dollar amount. This is what's going to make it worth it. Cause you're like, all I need you to go out there and do is spend an hour. Well, yeah, Evan, but I got to drive across town, and, so I'm going to charge you $300, $400. So, but that's what a small portfolio, it's kind of how it goes. So transition us a little bit into, because maybe somebody's question would be like, okay, Evan, I hear you. The CapEx will get you, and so you're not making as much, but don't you have CapEx on an apartment building? Aren't there some of these same things? So wouldn't I expect to feel like I'm getting all this great cash flow, and then all of a sudden these CapEx items sneak up on us with an apartment building? How's that different when you get into the bigger multifamily?
So as I see it, yes, the answer is yes. There are still CapEx, and oftentimes it's a bigger dollar amount, but it's less per door.
Sure. Yep.
And so if you're getting the same amount of rent, I use the simple example of a 4-family. My $6,000 roof would have probably only been a $7,000 roof on a traditional Cincinnati 4-family. 2 up, 2 down kind of property.
Not much bigger.
Now, instead of $6,000 for 1 unit, it is $7,000 for 4 units. And then you just scale that up. It's like, a 400 unit apartment complex might have a $2 million roof replacement.
Yeah.
But you have 400 units feeding into that. A big, there's a few benefits of going bigger. One, and this works with me from single family flips to rentals. And, I know there are great residential single family property management companies out there. Like I said, I personally haven't found them, but I have by no means exhausted the list of even just those in Cincinnati. But my general sentiment is the people who are really, really good at what they do move into bigger things. You have full-time maintenance people, typical.
I was going to bring that up too.
Large stuff is 1 head per 50 doors. So if you have 100 doors, you have 1 full-time indoor person and 1 full-time outdoor person, probably about that. But that person, that outdoor person might get a $40,000 a year salary. How many $300 leaky faucet repairs, calling a plumber, would it cost you versus just having this one guy who can, fix the leaky faucet, he can patch the basic drywall, he can, do this, that, and the other. So
you're usually getting better pricing with all those people because like you said, I mean, the commercial painter is going to make, do so much better going commercial. So he's going to give you a better deal per unit, right? So all those things end up becoming cheaper per unit, just like you said, you can spread out the roof. And so, it's a more expensive roof, but it's much cheaper per unit. It works that way in all those things.
And in my opinion, again, not having the full universe of data set, but it's the people who can scale into commercial stuff typically also can keep schedules. They can keep a budget. You get away from those fly-by-night handymen who are asking you for weekly draws based on percentages of work completed because they need to pay their guys. They can't keep a savings account.
So, Evan, I think we've set this up pretty well, and thank you for all that. And your experience too is helpful for people to say, okay, all right. So let's say we brought some of the point of saying, all right, Evan, I'm with you. I don't want to do single family, or maybe I already have, and I'm done doing that. So I want to get into multifamily. So that's what you do, Evan. You talk to investors that are ready to get into multifamily. So I know you've thought through this a lot, and you've coached people. You put out a lot of great content. I've benefited from the stuff that I've seen online, and you talking through stuff. So let's jump into that. And just if someone's ready to do that, 2 things I think you and I agree they need to do. You need to underwrite the sponsor. So and by underwrite, I mean just like evaluate the sponsor. So and that's the person putting the deal together. So the group you're going to work with. So Evan works with Ashcroft Capital, one of the biggest, best apartment syndicators in the country, in my opinion. You need to figure out if you think Ashcroft Capital is a good place to place your money, right? And that's the jockey. That's the guys, on Evan's team. They're going to manage that property, and they're the asset manager. So you need to do that. So let's talk about that, Evan. And then after that, let's talk about underwriting the deal. So Ashcroft does a bunch of deals. Here at Threeville, we've done a handful. And so, okay, I think Ashcroft's good, but maybe this deal isn't any good. So you need to underwrite the deal. So we're not going to have time to get into all the weeds, Evan. If someone wants to know more, obviously we're going to put your contact information. They can reach out to you and really get into it more. But just kind of high level, let's start with, how do you evaluate a sponsor? What do you coach people to make sure they're making a good decision by getting into the right group?
So as I'm looking for sponsors, I fall into the same traps as many people, and I won't call it traps. It's, you kind of invest in who you know. Now, I benefit because I work in this space, so I have a little more insight into who people are on a personal level. I'm meeting them at conferences. I've worked with them in the past, or they're friends of friends. But I'll look for the big ones as I'm looking at brand new sponsors. I'm looking at track record, and I'm comparing their track record to what they're currently doing, because there are a lot of groups that have pretty decent track records. But I've seen people who have used single family fix and flips on their website as a track record deal for them to buy, 150 unit apartment complex.
Right.
And I'm like, well, that's 2 different things. Like there's a little bit of connection, but it's mostly 2 different things. So not to discount that person, but I would focus more on the track record that is what they are currently doing, both in terms of scale of projects. If they're doing multifamily and retail, let's say, am I comparing their multifamily track record to a multifamily offering? General time horizons, so that's a big one that I'll look at. A lot of it comes down to just talking to the person. I'm a big one on, and especially with all the ability to automate things these days, not that it needs to be automated, but if I'm on somebody's website and I click their learn more button and then nothing, crickets, and then I start getting deals.
Yeah.
I'm not going to invest with them. Like,
Yeah.
reach out to me, even if it's an automated response. Like, give me a way to connect with you as a person. Not every, as you know, Lee, there's 506B and 506C offerings. 506C, the ones that can market, you never need to talk to the person. They could basically go through the whole process without ever talking to an individual. 506B, they have to stay compliant. Communicate with me, because my assumption is if you can't even set up an automated response to me, that if things start going bad once I invest, you're going to go silent on me.
Yeah, right. It's kind of like that. People have told me like things should be going really well when you're dating, because it gets harder once you're married, and then once you have kids, it gets even harder. So if things aren't good when you're dating, that's not good. So it's just like if the sponsor's not even communicating when he's
when they're trying to get money from you,
how are things going to go when he already has your money and they don't? Yeah. So I think that's a great point. Yeah.
And then the other one that, again, kind of falls in line with that, and there's a lot of questions that I'll ask potential sponsors as I'm looking to invest, but I'll always ask, can you share some referrals with me? Yes. And honestly, I've never once called them.
Okay.
I'm asking because if they wholeheartedly like, yeah, how many do you need? That's everything I need to know right there.
Got it. Yeah.
If they're like, well, let me check with a few people and I'll get back to you here. It's like, no, like as a syndicator, I think they should know that that's a question that is coming up. I'll add a couple smaller things that aren't diehard rules for me. Like those are three of the bigger ones. I like to see, some type of track record experience. And I don't mean this as like the actual company, because I'm an investor with a group that was only founded 1.5 years ago, but they were founded by professionals who I used to work with, who are 25, 30-year veterans in retail shopping centers.
Okay.
So like the company doesn't have a track record through prior recessions, but all three of the principals do. Things like that, particularly as we're going into a recession, especially now. I'm a little more diligent, and I won't say I'm focused on only fixed rate financing. In fact, in today's market, I'm probably opposed to fixed rate financing because I want them to be able to benefit from interest rates going down.
Right.
They will start tapering back to a more normalized level. I want you to lock in 7% today if you don't need to.
Right.
But that interest rate play and the type of financing and matching that to a deal.
Yeah. No, 3 really good ones. So yeah, looking for a track record with that sponsor. And I like the distinction, Evan, a track record in what they're trying to do. So if they're trying to, their current deal that you're looking into, and you say, hey, the sponsor has a deal, I'm thinking about investing with them. I'm going to, look at their track record, and the deal you're looking to invest with them is a 200 unit A-class building. And all they've ever done is 20, 30, 40 unit C-class buildings. That's very different. So you're actually investing in their first, 200 plus unit, and you're investing in their first A-class, so some very different things. So then communication, so important. Absolutely. And if they're not communicating well up front, probably a bad sign. Maybe it's a red flag. They're not going to communicate well as the deal goes along. Again, like you mentioned, Evan, especially if things don't go well, and you still want good communication, especially maybe if things don't go well. And then referrals, so important. So 3 really good things. You mentioned a couple others too, but those are really great ones. So let's say I'm bought in the sponsor, they check off all 3 of those things, and a couple of the other ones you mentioned. Now I'm kind of looking at the deal. What are maybe just 1 or 2, 3 things that you really would say a passive investor should look into when they're evaluating a deal?
And this is, admittedly to me, this is a slightly harder one. It takes more work. I won't say it's harder.
Yes. Right.
Because every sponsor is going to say, we're conservative. Well, great. What does that mean? Obviously, I think there's some general ideas. So I look for conservative underwriting, but to me, that is always an exit cap rate higher than an entry cap rate on their projections. Rent, projected rent levels with comps to back this up that are, stabilized rent levels below what current market levels are. So if they're doing again, this is assuming they're doing a value add. Let's say we're buying at an $800 in place rent. We're going to renovate. We're going to push it to $1,000. Great. I'm happy. Perfect. No qualms with me on that one. Unless all the comps show $900.
Right.
We're going to renovate to a higher level. I'm like, but what comps are you using? Because why aren't these other people doing that too?
Yeah. Right.
So kind of there's some nuance in that one. But if the comps are $1,050, $1,100 a month, and they're underwriting to 1,000, then I'm like, great, go for it. You're making the right moves. The big one, again, this is kind of back to, this could fall under deal or sponsor, but
Okay.
experience with their property manager.
Yeah.
So I will say I like vertical integration, but that's not a hard and fast rule for me, because I also like people to focus on what they're good at and
Yep.
outsource the rest.
Yep.
But in all my conversations over the years with investors, the common theme, not the exclusive theme, but the common theme is, when things are going wrong, it's almost always this was the first deal we did in this market. It's our
Yep.
first
Yep.
time working with that property manager. We thought we vetted them, and they didn't vet them as well as they thought they had. Or they vetted them really well, and the property manager lied to them, or whatever the scenario is.
Yep.
But I really like that.
Good caution there.
Yeah, like, have you been working with this property management team in the past? What's your experience? Do you know how they operate? Are they good with this type of asset? Because obviously, there's Class C properties or Class B properties, and there's Class A properties.
Yeah. Really good.
Management companies that focus on the A and B class might really struggle, even though the same business plan, with the C minus type properties, and vice versa.
I always ask my guests, and you're more suited to this than most of them, but I always like to ask, what makes a good real estate investor? What's the kind of maybe that key ingredient that makes a successful real estate investor? Well, let's take it to passive investor, Evan. So what's that key ingredient that you would say, hey, you need this to be a good passive limited partner?
Of course, you have to be willing to give up some control. Yeah. By nature, it's passive. I won't even say it's a good investor per se. It's almost a good sponsor to set the expectations appropriately and then live up to them. Back to the original three, communication being a big one. When you're talking to somebody, if they're telling you, hey, we send out quarterly updates, and you're like, but I really want monthly, then either vocalize that up front and say, can you do monthly? Because that's what I'm going to want to feel comfortable in this. And then be ready to step away if they say no. They just don't be that emotional tie to it.
Right. No, it's good.
That's a big one. And the other one I'll say is, the definition of passive is very subjective. There's the tactical version of what's passive income versus active income. Well, I, as a passive investor, consider myself a little more active. Like, I'm reviewing financials.
Yep.
And the reason being is, like, I plan on doing more investing. This isn't like a once, all right, that was my $50,000, I'm done forever, move on. I want to do more of this, but I'm not going to put all my chips in one basket. So I got to do my due diligence and work on the front end. And then I kind of have to keep working to make sure they're continuing to deliver what they say they're going to deliver. But it's kind of review financials, review those monthly updates, ask questions, because there's only one way you're going to get better at it.
I think the way you started off, Evan, know that you're going to have to give up control. If you're going to be a passive investor, I mean, we highlighted all these things about being an active investor that, you do have the control, and that's why it is all this extra time, and it is active, and it, becomes a job. And so if you want to go passive, just know you don't have to do all that, but you don't get to do all that. You're giving up the control. But I think what you said there was really good then. So decide what's important to you, decide what you need to have, and go ahead and vocalize that so that you know, as a passive investor, I know I'm giving up control, but I know I'm going to be comfortable because they're going to communicate with me monthly. They're going to communicate, whatever it is that you need to feel comfortable as a passive investor. It's so good. Get that up front. And then, okay, I'm going to feel better giving up control because I'm going to get the information I need. So really, really well said there. Transition a little bit. We like to focus on faith and family in this podcast as well. Evan, I know you're a family man. I know you got a couple young kids. How does your family fuel your investing? How is that kind of fuel what you're doing, or why do you do what you do, maybe for your family, things like that? Like, how's your family involved?
So, like, it's been nice because now we've gotten to work together on some of these flips that she's done. She helps me renovate my rentals as they've moved out of, like, the Section 8 world and things have gotten better. To come in and actually, like, design the house, and when we've needed some much more major renovations.
Neat.
So that's always fun to do together. But especially on the passive side, it's, it just comes down to financial planning and setting ourselves up, and, starting to create that income stream that, with my direct passive investments, it's money I thankfully haven't needed to live off of. So you let it kind of save up, and then you got another minimum investment for the next deal to come around. And then that fuels vacations and not having to worry about, oh, can we afford the zoo pass this year? So it really just comes down to like that financial freedom and ability to, have those fun discussions this time of year, like how much is too much for the kids at Christmas? Because
yeah,
you don't want to spoil them, but you also see all these fun things that you're like, oh, I really want to get that for them. And then you look at you start building up your Amazon bill, and you're like, all right, I'm gonna pull some stuff out of the cart now because that's just gonna be spoiling them. But it's really comes down to that financial freedom that really is just a tool to be able to not only spend the time as most syndicators talk about, freeing up your time through passive income, which is a big one. But in my eyes, it's can do what I do. I'm not having to report to an office. Now, partly that's a good day job while also creating some of that freedom through the passive income. And get to spend more time and poke my head out and have lunch with my kids. Even if I am sitting in this room for a solid 8 to 10 hours a day, most days.
Right. No, really good, Evan. When you say financial planning, I mean, I think about you and your wife, I'm like, I just imagine you guys are doing that together. And I think that's what's so important is you're doing that together. Like you say, it's fun because you get to dream together, but you just get on the same page and you don't want to have this passive income coming in and she's allocating it over here, where it's going right back out. And you're like, no, I thought that was going over here. And so you do that together and you get on the same page, and it sets you up for success. Then it's like you're doing it as a team instead of being pitted against each other. So really well said there. It's so important to get on the right page.
And the nice, the last thing I'll add to that, because it does come up a lot, is while we do it as a team, there's also of the two of us, thankfully, my wife is the more frugal one. So it's nice to be able to be like,
good. That's
honey,
great.
Like, this has come in. We have it to spend. Like, don't spend all of it, which she never would anyways.
Yeah.
But like, it's okay. You can go buy that new bench for our entryway that you've had your eye on for 6 months. Cause like we've made the money because we're saving it most of the time.
Yeah, that's awesome. That's fun. We're the same way. My wife I thought I was frugal until I met my wife. And now, I love to be able to say, like, go do that.
You're pushing them to spend money. Like,
yes.
We can
afford
afford
a good spot to be in.
I
think you and I are in a rare position here, Evan. We're very blessed with our wives. That's awesome. Wait a minute, good stuff. Hey, I always like to ask for a book recommendation. I've recommended Joe's. I think his is like behind me here. I always say it's like the textbook. If you want to become an apartment syndicator, but maybe thinking more for passive investors. Do you ever recommend a book to people considering investing passively?
I'll go with Brian Burke's. You've probably heard this one before, Hands Off Investor, because I think that's one. It's good. It gives good questions. Admittedly, I'm more of like a podcast listener than a book reader. When I read books, trashy spy novels to fall asleep to, as my dad calls them, trashy spy novels. But
well, cool, man. This has been really fun, Evan. We'll put all your stuff. I mean, Ashcroft Capital, that's a place for people to go. I know you're active on Bigger Pockets if people are on there, but AshcroftCapital.com.
Find me on Bigger Pockets. Find me on LinkedIn.
Okay.
We'll again, my day job is at Ashcroft Capital, but most of what I've been sharing on has been my personal, my investment stuff. So I always tell people, like, I wear those two hats, and for that reason, kind of need to keep them a little separate. But if you find me on LinkedIn or Bigger Pockets, message me there. Happy to communicate more. And depending on the direction it goes, we can certainly take this to a personal level, or if it's moving over to the professional level, we'll route it accordingly, just so I can stay compliant with my chief compliance officer and all the fun SEC rules that we're supposed to do.
Before I let you go, I always like to ask my guests before I let them go, how might my listeners and I be praying for you in the coming weeks? I'm
going to sound really cliche of just continued health and happiness and time together through the holidays here. I had a great Thanksgiving with my family. Smaller, less people came in than I am traditionally used to. So it was nice because it was more dedicated time, but particularly as we're in the Midwest and we never know whether it's going to be 60 and sunny or 12 inches of snow on Christmas. As family is starting to travel in, thankfully they come to us since we've got small kids now these days, for the most part.
Well, just it's such a precious time with young kids, holidays. It's so fun. So everybody can be healthy and just enjoy this precious time. It's really good. So I'd be happy to pray for that.
Well, thank you.
Again, thanks so much, Evan. This has been great, man. We'll put all this stuff in the show notes and send people over to learn more about passive investing and what you guys are doing there, what you're doing personally. Thanks again, man. It's been a lot of fun.
Thank you, Lee.
Yep. Take care.
Thank you for joining us for another great episode. I hope you'll take action on what you've learned today. If you enjoyed today's show, please consider leaving Lee a 5-star rating and review. And check him out on threefoldrei.com. Until next time, 1 Timothy 6:17.